Hey guys, this is Kent Hamilton from Crypto Day Trader, and today I wanted to go over basically what is Bitcoin. So first of all, Bitcoin is a digital token that can be sent peer-to-peer or person-to-person anywhere in the world without the need for a bank or middleman. Bitcoin was created by a person, group, or a company called Satoshi Nakamoto in 2009. And no one really knows who Satoshi is, and if they do, they're not saying. So I have my own theories of that, but I'm not really going to go over them in this video. So each time users send and receive Bitcoins, the transactions are stored in a digital ledger. Users can send Bitcoin to each other with or without downloading the ledger, as the security and integrity of the transaction on the ledger is validated by Bitcoin miners. This is one way Bitcoin as a digital currency differs from fiat, or in my case, US dollars. Bitcoin transactions are validated by miners around the world in a decentralized manner and are stored in wallets, not in one central place. In order to send and receive Bitcoin, individuals only need to have a digital wallet. So each wallet consists of an account number or public key, as well as a private key that is maintained by each user. When a user sends Bitcoin to another user, a transaction is created that contains a public address or key of the sender's digital signature, created uniquely for each transaction based on the private key. Each time a transaction is initiated, the transaction message, which is the public key of the sender, the public key of the receiver, the amount of the transaction, as well as the private key, is fed into a cryptographic signature creator in the wallet. This makes the transaction unique. So before the Bitcoin is deposited into the receiver's wallet, it needs to be verified to make sure that it's a valid transaction, and that someone's not trying to scam or take Bitcoin off the ledger. This is where Bitcoin miners come in. The miners, or those that have downloaded the latest ledger, randomly will be given a transaction to validate. The miner's computer will access the secure transaction via a public function that allows them to mathematically validate that the transaction signature was created by the sender first, and second, that the uniquely created signature applies to that specific transaction they're validating. These signatures are unique to each transaction and cannot be reused. Once the miner via a computer program validates that the transaction is valid, Bitcoin is then sent to the receiver's public address and is debited from the sender, and the miner is rewarded a small amount of Bitcoin called a block reward for validating the transaction. A block is a group of transactions that are validated via miners. Miners' Bitcoin block rewards are actually newly created Bitcoin. There's a finite number of Bitcoin that will ever be created. The total number of Bitcoins that will ever be created is 21 million. The block reward for each mined block will be halved every 210,000 blocks and will continue to decrease until all Bitcoins are mined. And once all the Bitcoins are mined and once all the Bitcoins have been mined and created, miners will then only be compensated via the transaction fee and not by the newly minted Bitcoins anymore. So in the beginning, before there were transactions, empty blocks were being mined with no transactions. The more blocks that were mined, the better the security. Once transactions started to happen, they were added to the mined blocks. So mining does two things: secures the blocks in the network and validates transactions. So you might ask, why doesn't everyone just mine the Bitcoin and get them for free? The answer is that the cost of electricity outweighs the value to create one Bitcoin, unless you have an incredibly large network farm mining Bitcoins, which costs thousands of dollars to build a server farm like that. You can still mine Bitcoin with a much smaller setup, but in most cases it's more profitable just to buy Bitcoin itself. So that leads to the final slide here. Basically, what gives Bitcoin its value? Bitcoins are not physical currency. They're a digital cryptocurrency. New Bitcoins are created as blocks are mined. Like I said, once 21 million Bitcoins have been created from mining, no new ones will be created after that point. Bitcoin gets its value from people buying and selling, so good old-fashioned supply and demand. Some have the hope that it will one day replace all currencies and treat it like it is. Some use it as an investment to grow, and they can use it to trade against other altcoins, which is what I do with it. In reality, for Bitcoin to actually become a currency, it will take a lot of time and to be liquid enough and have high enough market cap to be used as actual currency, and governments probably won't allow that anyway. So Bitcoin is mainly used as a place to create and store wealth, and as a trading pair to use to trade altcoins. Altcoins are any cryptocurrency created that is not Bitcoin, and that's where the alt comes from. It's an alternative to Bitcoin. So, in my opinion, Bitcoin is one of the most profitable investment opportunities we'll ever have. So if you're new to Bitcoin and you want to get started, you can go to Coinbase.com and buy Bitcoin there, or Ethereum, which whenever you want. I would suggest Bitcoin. You can use my referral link in the bottom in the description of this video, and I'll get $10 and you'll get $10 as well after you buy $100 worth of Bitcoin. And that's it for this video. I hope you liked it, and I'll see you in the next one.